The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm the host, Brian Akers. Today I have with me financial planning advisor and MBA, Paul Franco. Good morning, Paul Franco.
Good morning, Brian. How are you?
Doing very well. I'd like to welcome everyone to our show today. I am Brian Akers, president and founder of Akers Financial Group. Paul and I have been working on a good show for today.
Yeah, this is one that I'm pretty passionate about.
I mean, is it a good show? I think it's a great show.
I think it's a great show, too.
Well, it's something where, if you've listened to our show the last few years, we have not covered this topic like we've covered it today. So make sure you listen to the whole show. When we're talking about this show, we're going to be talking about some really good things. And that at halftime of the show, we're going to cover a way to save money that's pre-taxed and you pull your money out qualified tax-free.
Right.
And Qualify has some rules to it. We'll cover that after halftime of Winning in Retirement. So stay tuned throughout the show to hear all these great ideas on how to add tax-free to your portfolio. That's exactly what the topic is called, how to add tax-free to your portfolio. So Paul and I have been, how do you say, studying, researching?
Always.
Working, but also came together to put together a show that's going to be really good for us to go through today.
Right. It's important that, we stay up to date with all these rules. They change always.
Yeah. So on our website at akersfinancialgroup.com, you can see lots of shows we've done on Roth IRAs, Rothifications, how to do Roths and things like that. But today we're doing a concept called adding tax-free to your portfolio. So I thought we'd start out with some basics and then just build from there. All right, the first one is Roth IRA. So Paul, you and I have clients, and those clients might not have a Roth IRA, or they might be a brand new client, and we try to find a way for them to use the idea of Roth IRA. Can you cover some basics that you would say to that kind of client who's never had a Roth IRA before?
Sure. Yeah, I see it all the time where somebody comes in and they may not have even heard the term Roth IRA before. But the idea of a Roth IRA is, at a simplest standpoint, is paying tax now and never paying again. That's kind of the easiest way that I'd explain a Roth IRA, is paying tax at today's rates, but never again.
Right. Yeah. So the Roth IRA, what we're going to talk about first is the Roth IRA is an individual account where you set it up. It's not through an employer or anything else. We're going to cover that later. But a Roth IRA is an individual retirement account that is under the Roth law, which started way back in 1998. This money will go in after tax and be tax-free when you withdraw for qualified reasons. So, Paul, what kind of limits do people have? How can they open things like this? How do they start it? What kind of money do they need?
Sure. Well, it's important to know that it's really meant for kind of middle-class income individuals, maybe higher middle-class individuals. If you make too much money, you're not allowed to contribute directly to Roth. So ideally, if you're able to make contributions to a Roth, you have earned income, meaning you have income from like a W-2 from your work, and the maximum that you're allowed to contribute for 2023 is $6,500 if you're under the age of 50. But if you're over age 50, it's $7,500. They give you a $1,000 catch-up contribution.
Yeah, catch-up provision is for the people over 50.
Correct.
Does that mean people over 50 are elderly now?
No, that's still young. I still think if you're in your 60s, 70s, you're still pretty young nowadays.
Yeah, thankfully what they did is they allow you to put more money away for those who haven't saved before. So today's show called Add Tax-Free to Your Portfolio. One way to add tax-free is to have an account where you're putting money in, and then as it grows, it'll grow tax-free, and everything on the way will be tax-free. Now, for a Roth IRA, there are limits to income. So when Paul was mentioning middle income and a little higher, what we're talking about is the income limits for Roth IRAs. If you're anywhere near the limits that we're going to cover, we want you to maybe wait a little longer to contribute. The Roth IRA contribution season runs from January 1st of the year all the way to April 15th of the next year. So you can get your W-2 in, even do your taxes, and then put your Roth contribution in if you get too close to these limits. Paul, do you mind going over the limits? You have them right there?
Yeah, so the 2023 limits, if you get close to these amounts, like Brian was saying, there's actually a phase out where if you're between Right now for 2023, if you're married, it's $218,000 and $228,000 of adjusted gross income. Then you actually, if you're between those limits, the $6,500 or $7,500 you're allowed to contribute, it trickles down. If you're over the $228,000, you're not able to contribute directly to Roth at all.
What's a financial trickle?
A financial trickle?
Yeah, you said it trickled down. I just want to.
It trickles down. It slowly. If it's $6,500, it diminishes over time.
Yes.
The amount that you contribute is less. It might be.
Oh, sure.
$6,000.
Yeah, so they shut off the valve, right?
Right.
That's what the trickle comes from.
Yeah.
You get a little less trickle. Yeah. I'm sorry.
It's when we talk about Roth.
Yeah.
There's a lot of different planning topics that we need to work through when we're looking at your income. Like Brian was saying, where waiting till you get your W-2 is not a bad idea, because sometimes you get hit with a surprise bonus at the end of the year, and little did you know, now you're not able to contribute directly to Roth.
Yeah,
So
I just had one in the person in the other week, and we had to do that. They ended up doing so well in their construction work that they were able, between their husband and wife, they went over the income limit, and I had to tell them that we have to go back and redo your Roth and take the money out. And so there is a calculation through the Roth IRA to have that done. That's why it's great to have a financial advisor to guide you through this. Now, the cool thing about a Roth IRA, there's no age limits now, right?
Not anymore.
That means if I'm pulling in, I'm 75 years old and I'm making, say, 15, 18,000. I'm doing some driving pickup trucks or whatever, having some fun, and I make some earned income. I can put that into a Roth IRA, right?
That's correct. Yeah. So it's really it's a benefit for, we do have a lot of clients like that where they retire, they work a little bit part-time, maybe as a teacher or, driving trucks.
Yep.
It might be that as long as they make over, in the case where you're 75, if it's $7,500, if you make that in your earned income, then you can contribute that to your Roth. It's very important to know that if you make less than that in your earned income, let's just say, for example, you only make $5,000 of earned income, you cannot contribute the maximum $7,500. You can only contribute enough to get through, enough to maximize what you made for that year. So the $5,000.
And that's one reason to wait to January if you're close, or if you have a side job, you're not quite sure if you'll get to the limits. Now, if you have one that goes out and works during the retirement years and they're making, say, $15,000, you can actually do a spousal Roth. They don't have to work, and your Roth. It's a nice way to set some money from a taxable bank account to a tax-free bank account. The Roth IRA can be invested in anything. It can be invested in CDs, just like at the bank, in a savings account, which wouldn't recommend that.
Sure.
We'd want to make some interest, or into mutual funds and stocks, and any kind of portfolio you can build and grow over time.
Yeah.
Which will be tax-free to you as you pull it out, and tax-free to your kids when they receive it. Legacy benefits, all tax-free.
And that's why, it is important to have a financial planner looking at, what should we be investing the Roth in? Because you're not going to want to own municipal bonds, types of investments that are federal and state tax-free already. You don't want to put that in a Roth. It's no added benefit. So, it's really important to know what you're investing in, what kind of different strategies that you have in that account.
We've even had the ability to help people that are under 18 through the proper paperwork, and they have an earned income through a job to put some of that money into a Roth IRA.
Yes.
Typically, when you're 18 years old, you can do it on your own and start doing Roth IRA. We highly recommend you do something with a Roth. It could be $100, $250. Get it started. Put money in.
Yes, like Brian said, getting it started is so important. There's a concept that people don't talk about too much with Roth, and it's a 5-year rule that you have with Roth IRAs that it makes sense to, even if you just start it when you're younger and put $100, $200 into it just to get that 5-year window started. It's very important. The 5-year window is something where if you're in your, let's just say, when you're 58 years old, you want to retire at 60, you haven't had a Roth IRA before, you make a contribution at 58, you really, if you want to take that out tax-free and penalty-free, if you want to take out the earnings tax-free and penalty-free, then you have to wait 5 years in order to do that. And we can talk more about that later. And that's really why it's important, though, to have a financial planner, working with you and knowing these rules to help you out with them.
It's Roth IRA. The show today is called Add Tax-Free to Your Portfolio. We're starting with the basic. This is basics right here in the first quarter.
Right.
A Roth IRA. Do you meet the limitations to be able to do it? And are you doing it? If you're not, let's open up a Roth IRA and get it started. Let's get a Roth IRA going for you, your spouse. Get that Roth IRA going where you put some money away. We have clients that gift money to their kids so they can fund their Roth. The earlier people fund their retirement accounts, the better. Imagine that money that you put in will then grow tax-free, and that growth money, whatever it's worth down the road, will be tax-free to you when you pull it back out at retirement. Yeah, that makes it very valuable.
Yeah, I'd recommend anybody just look up Peter Thiel when it comes to Roth IRA and just see the story that he had, a few $1,000s in a Roth in the late 90s, that he grew into a multi-billion-dollar account that's all going to be tax-free as long as he waits till 59 and a half to withdraw. It's there's fun stories like that.
Yeah, well, he bought a company, and there is some IRS looking at what he did, and they're trying to shut down the idea of what he did, which was...
He was a founder of PayPal, right?
Yeah, but he converted stock into his Roth IRA, and then over time it blew up to billions.
Right.
And so the IRS is trying to stop that huge idea.
Is that surprising, though, Brian?
No, it's not, because, you did something right. You did incredibly well. We don't like that. But generally, the Roth IRA has been a great fund and a great way to build wealth and have money that you can get to when you retire, because that money is your money. You don't have to share it with anybody else. So adding tax-free to your portfolio, the first idea we have for you this show is the Roth IRA. Add it to yourself. Open an account. Give us a call to be able to work with you on that. Now, at Acres Financial Group, you know that we're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville and Forest Hill and clients all around the Mid-Atlantic region, all around the country, even a few around the world. It's so easy to begin winning in retirement. To actually win in retirement, I would say tax-free sounds like winning at the best level. So go ahead and give us a call and schedule your free meeting with one of our team of advisors to go over topics like we talk about today. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. You can go to acresfinancialgroup.com. You go to that website, you check out the area where you can basically submit an opportunity to meet with us, fill that out, and then we'll give you a call to set up that time. You can also call us directly at 833-946-7384 to start planning for your retirement now. How can you create a tax-free retirement at your work? We'll cover how you can do this in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm your host, Brian Akers, president and founder of Acres Financial Group. Today I have with me financial planning advisor Paul Franco,
yes.
MBA, all-around good guy.
Yes, sir.
A great guy.
Great guy.
What you'll find from Paul Franco is that he's extremely well-read. He's well-versed, well-trained, and ready and willing to work with many, many different people. And what's great is Paul works with people of all different ages when it comes to helping with ideas like we're covering today. So Roth IRA is not just for a certain age group. It's for all age groups,
right,
Paul?
Yeah, I mean, my youngest client might be, I think she might be 18 or 19.
Right.
I meet with her 15 minutes a year. It's like you're $25 a month to a Roth.
Yeah.
Then I have clients that are older, and we're doing nursing home and estate planning, different things like different strategies like that. So
nursing home Roths.
All different. Yeah, not doing Roths necessarily.
Yeah. All right. Well, all right. So today's show, if you're just tuning in, is called Add Tax-Free to Your Portfolio. If you're just tuning in, you missed the first quarter. The first quarter was incredible about a Roth IRA. But this quarter, we're talking about how to create a tax-free retirement account at your work. This is different than doing a regular Roth IRA. So, Paul, start explaining what a Roth at work might look like.
Sure. I mean, normally when people make contributions to a 401k is the workplace plan that you have through your job. And most companies do have a 401k that they have through the company you're with. Now, you make contributions typically pre-tax, where when you contribute could be, let's just call it $10,000 in 1 year, you get a tax deduction of $10,000 off of your income for that year when you contribute to it. The difference is now most plans, I don't want to say all plans, but most plans allow you to make Roth contributions to your 401k, Roth 401k contributions, where you don't get the tax deduction like you would on the pre-tax side. But if we still use that same $10,000, that $10,000 that's in the 401k, that's in the Roth portion, grows tax-free. Still gets a match from the employer. The match is typically a pre-tax. That's because the employer is getting a tax deduction on their match. So that portion would be in the pre-tax bucket of the 401k. But then your contributions could be going to a Roth 401k that's growing tax-free.
Right. So let's picture people that are working, and you can work in any kind of job, maybe a nonprofit type of job, hospitals, school teachers, things like that. Now, some of them offer 403b Roth options.
Right.
Many of them do not. Now, as you go to a federal government, the TSA or TSP, the TSP has a Roth option.
They do.
And then private industry, many of them have Roth options. This has happened over the last few years. Now, let's talk about just a simple basic. If you want to add tax-free to your retirement portfolio at work, you go and switch from pre-tax to Roth. How is that going to affect someone's paycheck, Paul?
Well, so as far as your paycheck goes, you're still contributing exactly what you'd be contributing before if it was pre-tax. The difference is, though, now your taxable income for, if we call it 2023, your taxable income is going to be higher for this year. Mm-hmm. The benefit, though, is that you don't pay tax ever again. So when you do need the withdrawals from the 401k, when eventually you do retire, you take them out tax-free.
Right. So what happens right now, if you're doing $100 out of your pay, that's going to basically, if it's pre-tax, you basically it's going into the contribution. You don't pay tax on it. You just pay Social Security tax here. And Maryland, you get a deduction. If you live in Pennsylvania, you got to pay tax on it, just to confuse people. Mm-hmm. But the idea is that if you switch to a Roth, you're actually going to bring home less pay. And the reason is that all of a sudden that $100 that you're putting into the retirement plan is going to be after tax. So now you pay Social Security and everything, but also your federal and Maryland, and that money you'll have the net come to your checking account. So the idea of switching to Roth does cost you some money right now because you pay tax on the contributions. What I'd like to describe it is this way. When you're putting money into your Roth, you're paying tax on a smaller amount. You're paying it on a small stack of money. As we put it in and let it grow, and it grows and grows over your career, that large stack of money, not taxed at all because of being a Roth. The Roth 401k, the Roth TSP, the Roth other accounts that are available through work, that's going to be tax-free to you. That's all your money. The opposite is what we do all these radio shows about. When you put money pre-tax and it grows very well, all of a sudden you have all these tax issues in your retirement years.
Right.
That's what we're trying to prevent by adding tax-free to your portfolio.
And we're historically in very low tax brackets right now. I mean, the highest marginal rate's 37%. When World War II, it was 94%. So we're historically at incredibly low tax rates. Paying tax now and not having to pay it again is a really wonderful concept. And in practice, I mean, if you're making contributions, let's say you're maxing it out each year and you grow your 401k to $1 million, let's say, if it's pre-tax and you're in a 40% tax rate when you're eventually going to need to when you retire and you're withdrawing that between federal and state tax, that's $400,000. You're only getting $600, right, Brian? So imagine that $1 million is now in Roth. That $1 million, when you start withdrawing those funds over your lifetime, that's going to be completely tax-free. Mm-hmm. And that's a huge benefit.
Now, we can contribute more through your work than a regular Roth IRA. You can contribute the limits. Now, most 401k limits are $22,500 if you're under 50. Then it jumps up to $30,000 total, counting the catch-up provision for those over 50 years old. So that's just a great idea on how to save money doing it that way, which is doing basically after-tax Roth. That after-tax Roth will be money that's going to be growing in that portfolio. And then when you retire, you make sure you roll it to a Roth IRA, and and you don't mix these funds later in life into a pre-tax or do some paperwork mess up down the road.
Don't want to do that. Nope.
Now, when you are going to want to make this change, you want to add tax-free to your portfolio, you're going to go to your 401k website. You're going to go under the contributions, and what you'll find is that you're even allowed to have some Roth and some pre-tax. And so one way to introduce Roth into your paycheck and your net paycheck is to have something go to Roth and something go to pre-tax. And then as you can afford it, you work in more and more Roth, and then before you know it, you won't notice that you paid a tax on it. You just live off the net, and then you're golden.
That's right. Yeah, and it's really important, I believe, to have a financial planner working alongside you to help determine how much you should be splitting between pre-tax and how much you should be splitting with Roth. You know, it's just in some situations you might be earning, so much money right now, and you are going to be in a lower tax rate later. And so it might make sense to only split, might be 10% pre-tax, 10% Roth. It might actually be no Roth, but working with a financial planner to be able to help you make that decision is very important.
Absolutely. Now, the other thing that we have to do is when you're working with your 401k is understand that there's a new law change out there. And that is companies can actually allow the employer contribution to become Roth, to be after tax. But you as an employee would have to elect that.
Right.
That is something that's coming to your current plan in the next year or two. It's available now under the law, but it's not in every plan or most plans or any plan that I've seen yet.
It hasn't had enough time to roll out, right?
The lawyers are working on it, but the idea is that if you change the employer contribution to be Roth, then you are going to have to pay in a current year the taxes on the money going in that way from the employer also.
Correct. The way I understood it is, it's basically additional just taxable compensation is how it would show up on your W-2.
Exactly right. So what happens is this is if you're looking at ways to save money to make your retirement just incredible, we love adding tax-free to your portfolio. Adding tax-free through your work is the idea of the quarter. We think that's a great thing for you to do. What you do is we'd love to sit down and talk to you about how to add this in your situation. You need to look at it. So if you're driving around, just think, Roth at work. That would be the thing you need to think about. And then go ahead and give us a call about that.
Exactly. I agree.
And people always call 833-WIN-RETIRE, All right. So now, as we're talking about this, it comes up with another tax-free idea that people can do. And that is your permanent life insurance is also a tax-free investment vehicle. Can you explain a little bit about that?
Yeah, it's one of those that, let's just say, imagine you are maxing out your Roth IRA. Let's say you're under age 50. You might be maxing it out $6,500. You're maxing your, 401k contribution. And we're looking for additional ways to create tax-free income. Life insurance is a way and strategy that we can do that. Cash value life insurance, where the cash value builds up over time, and through loans, which like I say before and continue to say, meet with a financial planner to help them explain this to you. But be able to, through loans, through the buildup of that cash value, have a tax-free benefit through insurance.
Right. So if you have a policy, whole life, universal life, anything like that has cash, there are ways for you to grow that money over time and to take it tax-free through the use of withdrawing of the original money and a concept called borrowing or loans from the existing policy. But tax-free can come out of your life insurance also as a way to have some other money that's growing tax-free. This is a concept that's used for middle and higher income because of maxing out at work at a low level. I had one the other day where at 5% of their pay, they hit the maximum 401k limits, and we're just trying to find other ways to save money. Right. And life insurance could be that way for you.
And real estate people love cash value life insurance.
Why is that?
You build up the cash value to buy your next property.
All right. That's going to be another concept we can cover in another show.
That's right. That's right.
What I was going to say about the life insurance is that life insurance is something we need at certain times in life. And there are different ways to use the vehicle to be able to grow your money if you can afford to put extra money into it to build up a cash value. Life insurance tax-free is another concept of how to add tax-free to your portfolio of investments that you're trying to build for your lifetime of funds. At Acres Financial Group, everything we do is about you. Your retirement is as unique as your fingerprint. When you sit down with us, we start by taking a look at your financial fingerprint. We talk about you and where you are right now. What is your net worth? How do you invest? How much are you earning currently? And then we talk about what you want your retirement to look like and feel like. That's a retirement fingerprint. Perhaps you've been sold something, regardless of whether you need it or not. Not at Acres Financial Group. With us, your retirement money follows your financial fingerprint. It's a retirement plan based on your unique fingerprint that determines where your money goes. It's not about us, it's about you. Go ahead and give us a call at 833-WIN-RETIRE and schedule an in-person or Zoom meeting with one of our team of advisors. That's 833-WIN-RETIRE, 833-946-7384, or visit our website at acresfinancialgroup.com. Scroll down to the bottom of our homepage and schedule a meeting right there. Call 833-WIN-RETIRE or go to acresfinancialgroup.com. Pre-tax and tax-free sounds great. Never tax is even better. We'll explain in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome to the second half of Winning in Retirement. I'm Brian Akers from Akers Financial Group. I'm a certified financial planner practitioner. I'm president and founder of Akers Financial Group. And we welcome to our show today Paul Franco. He's a financial advisor, MBA, and here today to talk about the second half topic. Are you ready, Paul?
Yeah, I think I'd consider myself a second half player.
Second half? Okay, you don't use it all in the first half?
No. You got to reserve a little bit, right?
I don't know. I don't like reserving. I like second half. I get juiced up, talk with the coach, eat a little bit, and I'm ready to roll again.
Maybe a kiwi or a banana.
You're a kiwi guy.
I'm a kiwi guy. Yeah.
I never ate a kiwi at a sporting event.
Well, imagine back when I played soccer in college, it was mustard just straight out of the packet.
Yeah.
80th minute, you're cramping up. You're drinking mustard right out the packet.
Well, back in the day when I played, back in the I think me and James Naismith played basketball together.
Oh, yeah?
Do you know who that is?
Oh, yeah. Yeah. Legend
from Kansas in the 1800s, created basketball.
Yeah, I know, the inventor.
Yeah. Right back to another incredible subject called adding tax-free to your portfolio. This has been our subject today, is how to add tax-free right now to your portfolio. The one thing that we want to talk about is this idea called pre-tax and tax-free. It sounds like never tax is the idea, and we're going to go over this quarter. What we're going to talk about is through your work, you have health plans. There are different types of health plans, and then there's different ways of saving for your health expenses. What are some examples of those health ways to save your money to cover your health expenses?
Sure. Well, typically there's HSA, which is health savings account. You might have a FSA, which is a flexible spending account, which you could argue how flexible is it on the spending side. And then in some situations, you might have a health reimbursement account that you have through your employer. So
Right.
those are three of the ways.
All right, so basics of a FSA, a flexible spending account, is that's the one where you have to figure out how much you're going to use that next year. You got to set it early in the year, and then whatever goes in, if you don't use it, you lose it.
Yeah,
That's not a fun account.
Use it or lose it is how I explain FSA. And there is a little bit you can roll into the next year if you don't use it, but it's small. It's basically use it or lose it.
Yeah, so FSA is not this super idea we're coming up with today. The health reimbursement, the HRA concepts, those are ways to put money in, but doesn't have all the advantages of the one we want to talk about. That one's the health savings account. How is someone eligible to have a health savings account, Paul?
So if you have a high deductible health plan, that makes you eligible to make contributions to a health savings account.
Right, high deductible health plan. That means your insurance through your work. This is only for people under the age of 65.
Yep.
That's not under Medicare. This is before that. You can have a high deductible plan. You have to have that to be eligible to put money into a health savings account.
Yeah, imagine if you're maybe married, 2 kids, you go to the doctor once a year for an annual checkup. You probably signed up for a high deductible health plan. It wouldn't make sense to take the lower one with the higher premium. So that kind of individual, few times a year, who has that high deductible plan is eligible to make those HSA contributions.
Right. So that high deductible plan is where you are responsible for paying those bills. And so what we want to talk about, first of all, is when you're doing a health savings account, you have limits to what you can contribute. And what are those limits, Paul?
Right. So the limit for 2023, if you're for individual coverage, is $3,850, and for family coverage is $7,750. And each year, those really do change.
Yeah, they are indexed. If you just happen to be over 55, you can put another $1,000 into your catch-up provision inside that health savings account, which is a nice way of saving money. Now, HSA can be funded by your employer or by you, and the money goes in pre-taxed. If you put your money in, you then have to take it off on your tax return as a health savings account contribution. You got to make sure you cover that on your tax return. The employer can lower your income by that, which is nice.
Very good. Yes.
And this works in almost every state in America, but two.
Yeah.
Can you name the two, Paul?
No, you go ahead.
I knew this one was. I didn't know this until this morning. California and New Jersey did not let you deduct your health savings from your income, but that's just the way it works there. Now there are some other rules out there we're going to try to cover. So HSA, the money goes in. How do people use their HSA account?
So usually people use it to pay for your deductible. You help pay with your co-insurance, co-pays. You might pay.
You get a card.
Prescriptions. Right. You have a card. Exactly. Right. It's basically like a debit card, essentially. And you can also actually just, if you want to reimburse yourself, you just keep those receipts for what you paid for those qualified medical expenses. Like I've said before, though, I really do like the idea of building an HSA, paying out of pocket for, prescription costs, the $20, $30 if you can, and build that health savings account because of that tax-free benefit. It is a huge benefit.
Paul's already giving you the secret sauce right now. All right, so this is it. This is what the big deal is that we can put money pre-tax into a health savings account. Now, normally, all of us use it. We're constantly using it for dental or eyeglasses or vitamins, and we're using the money. You put $1 in, $1 comes out. But guess what? The idea is this. Don't use it. Let's leave it alone. Do you know if you spend regular after-tax dollars on your medical, you can then save those receipts to take your money out of your HSA in the future, like a long time in the future. Now, you can't take a medical deduction that year with them. So if you have too many medical expenses, you're going to want to take that on your tax return and not save that for a health savings account retirement idea. But the idea is this. If you pay your own expenses out of your other money, and then you let the HSA grow tax-free, the tax-free part is the money is going to be used for your retirement. You can use it for your retirement health care, your long-term care. Anything you need medically in those retirement years can be built. In an HSA plan, once you've established it and built up a certain amount of money, $1,000, $5,000, you can actually start investing, right, Paul?
Yeah, that's right. Typically, it's you might have it at like a bank where it's not really earning anything, but eventually, you actually can invest those contributions in the earnings that you have in there.
And what kind of investment choices do people have?
You can do stocks, bonds, mutual funds, ETFs. You own it. If you own it in a brokerage account, it's like basically an individual brokerage account where you have your choices that you can make through whatever your brokerage firm is.
Right. So basically what we do is you begin with a basic HSA plan where there's like a cash savings type account, and that has a debit card tied to it. Once you get to a certain limit, you can start putting other money into the HSA investment account, letting it grow tax-free and be used tax-free later in life. So this becomes a part of your retirement plan, a health savings retirement plan. Some people call the idea health IRA. It's not officially called that. It's an HSA account, but it's a way of saving money for these future high expenses. Why not do this? Let that money grow at like a stock market rate of return, 8 to 12% over time,
right,
and then touch it later. I like the idea, but I love the fact you can save those receipts and you can pull that money out when you need it later.
Yeah, it's a cool tool to use. You're making pre-tax contributions where you get a tax deduction on your contribution and you get to take it out tax-free, like Brian was saying.
Yeah, and that's what the word never tax is what you just described. Never tax, because it went in before tax, comes out tax-free. No taxes at all.
Right, and that's the difference between that and like a Roth account, where if you're in a Roth IRA, you don't get the tax deduction now, but it grows tax-free. The HSA, you get the pre-tax, you get the deduction, and it grows tax-free. Never taxed, exactly like Brian said.
Okay, so what happens is this. You got to find out if you have an HSA. Most of us know if we have an HSA through work or not. If you have it, then you have these options. And then one of the ideas we're giving you today is think about not using it. Now, you can use it if you need the money out of there because that's what it's there for. Right. But if you don't use it and let it grow, that's a great thing to build another fund for your retirement years. So one of the things is this: are you maximizing your health savings account? Are you putting enough money? What are those limits again, Paul?
So it's $3,850 for individual and $77,750 for family.
Right.
It's hard to keep up with them every year.
Well, and then if you can add an extra $1,000 for those over 55 to put more money in. So if you want to find ways to save more money, what's great is there's no income limitation on this. There's nothing like that. Right. So it's a really nice way to put some money away.
Right. Oftentimes your employer also makes a contribution too. When you make a contribution as an employee, an employer might match a contribution as well. So
that employer is subject to the same limit. So if they put in $3,600 and you're single, you can only put in like $250 bucks above it. So you have to know what's going on with the employer. Now, there are a couple of states that will actually tax the growth. They're like New Hampshire and Tennessee. So if you retire to Tennessee, it might not work out perfectly because you pay tax to them. But Tennessee doesn't have a lot of taxes.
Yeah.
It's very much a tax-free state, in case you wanted to know. So the idea is this: adding tax-free to your portfolio. The idea here for the third quarter has been the health savings account. Are you using that to the fullest? What do you think, Paul? Do you think people are using it to their fullest?
I hope so. And really the importance is to find out. I've said this before. Know your benefit package that you have through work. You might find out that you're HSA eligible and you could be making these contributions without even knowing it. So,
most people are putting some money in, but maybe not maxing it out. It's another thing to look at. Maximizing your Roth IRA contribution, maximizing your work contribution, maximizing your health savings. All of these are ways to throw money to your own future because we are responsible for our own future financial plan. Now, as you're thinking about these ideas that Paul and I are talking about, you're going to think about, well, where do I start? I need some help. And that's exactly what this radio show is all about. We want you to win in retirement. We think winning in retirement is really tax-free. I really feel like winning when it's tax-free. So what we want you to understand is how to maximize all of these benefits. So what you do is you give us a call at Acres Financial Group. You can go to our website, acresfinancialgroup.com, or you give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. And we'll call you on Monday on the schedule of an in-person meeting to go over exactly what's available at your work, what you're doing now, and what are some other ways to add tax-free to your portfolio. That's winning in retirement. So give us a call, 833-946-7384, to start planning for your tax-free retirement now. Design your retirement health account tax-free. We'll explain when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hey, welcome to Winning in Retirement. Actually, the fourth quarter of Winning in Retirement. If you've missed any of our shows so far, you're going to want to listen to this show. Go to our website at Acres, AKERS, financialgroup.com. Go to that website And on that website, check out the radio tab, and down below there, you can actually see that we have all of our shows listed. You can listen to our show straight off the website, or you can actually go to podcasts and look up Winning in Retirement and hear it through podcasts. Really, any podcast program that you might have. That show today is called Add Tax-Free to Your Retirement. We're trying to help you add tax-free to your retirement. The reason we've done that today is we believe that this is one of the best things you can do for your retirement years is to have tax-free money that you can use in any way that you want. Now, we have Paul Franco in here today to talk about this. Paul Franco, you've been feeling all right today?
I feel good.
And you're good to go for one more quarter.
Yeah, one more quarter is okay.
Fourth quarter is winning time, so many football teams put all four up in. Means that they're ready to finish, ready to bring it home, and that's where we are.
Yep, no overtime, right, Brian?
We want to finish it, especially if you're the Wade team. You want to finish it right there. You take the shot.
Your chances go down.
But you don't want to go to overtime.
Right.
All right. So the idea of the fourth quarter is this: is designing your retirement healthcare benefit tax free. Also, designing that account, making sure you do things the right way. So far in today's show, we've talked about Roth IRA, how to add to that. How to add through Roth through work benefits. We talked a little bit about life insurance tax-free benefits, and then we came with the secret one. The idea of the health savings account, how to put money in pre-tax, let it grow tax-free, and then withdraw tax-free for any health benefits or health costs that you have throughout the retirement years. So, Paul, when it comes to HSAs and designing them, what has been your experience with some of the people you've worked with?
Most of the times it's having an HSA balance that's tied to a bank account with just a fixed small interest rate.
Sure.
And most of the times, people don't know that you can invest your HSA. And that's kind of the first learning topic that we go through is, yes, we can truly invest this account and try to get good growth in there so that eventually when you need it and when you retire and you have this balance, it can be at a larger balance than if you were just getting 0.1, 0.2% through a bank.
Absolutely. So the idea that Paul is mentioning is the fact that once you build up your health savings account to $1,000 or a few $1,000s, you then can actually begin to invest money for the longer term if you can afford to let that money grow longer term. What I mean by that, if you don't need it for your medical expense, you have other money, you can let this HSA grow tax-free, and then it can grow. You don't pay tax as it's growing, and then when you sell it, there's no tax then. And then as you withdraw, there's no taxes if you use it for the right reason, which has to be health related, just like the HSA account's set up for.
Right. Has to be qualified health expenses. Yes.
Yeah. And we're going to have those in their retirement years.
Right. Healthcare is a huge concern in retirement, is the rising costs of healthcare throughout your retirement.
Yeah. So HSA, health savings account, you got to find out if you're eligible to have one at your work. And if you are, then you need to use it. We have found many times that people do not maximize what they put in their health savings account each year. This has to be done during the calendar year. Unlike Roth IRAs, it can't be done after the year's over. It has to be done during the regular year, January 1st to December 31st. So you need to understand where you are and see if you can get enough money in there.
Yeah, and that's what's a little different about the flexible spending account, the FSA, and the health reimbursement account, the HRA. The FSA, you know what you're going to be contributing from, each pay or each month that you're doing, and it's available from day one of that calendar year. With the health reimbursement account, that's all employer sponsored. Employees aren't making any contributions to those. So, it's almost like an added bonus through an HRA. But today, like Brian's saying, the HSA is so important just to know, do you have one, or do you have a high deductible health plan? Are you eligible to make these HSA contributions? It's really important.
Absolutely. So today's show is called Add Tax-Free to Your Portfolio. And let's say you're driving around, you're thinking, hey, tax-free. All right, so what does that really mean? Well, let's go with some basic concepts. One is this: you have to pay the tax now in most cases, except the HSA. And then it comes out tax-free over the years later on when we need the money most. We are trying to throw money to your retirement to where that money is your money. If we can make that tax-free, we're helping your retirement be an easier thing for you.
Yes.
Taxes is one of the biggest expenses of retirement years, right, Paul?
Right, and we don't have the golden ball to tell us what our tax is going to be in 10, 15, 20 years. But the reality is that we believe taxes are going up. So paying tax now and never having to pay them again, eventually when you do need those funds later on when you retire, to be able to take those out tax-free could save you a lot of money.
All right, so let's talk about a little bit about people of different age groups. Someone in their 20s and 30s, they have a high deductible plan at work, or they chose a high deductible plan during their open enrollment, and they never even set up their health savings account. What's some basics that they need to do?
Yes, and I've seen that before where, hey, I have a high deductible health plan, but I haven't been contributing at all to an HSA, didn't know that was available. Reach out to your HR department and figure out, do you have an HSA that you can contribute to through that work plan? And is there a match? Is there some sort of benefit that the employer gives you as well?
All right, so getting it set up is one of the key things to do. Many times when people start a job, they don't check all the right boxes. They don't call the financial advisor before they turn their paperwork in. I think it's a very valuable piece of our planning is to offer you the right advice as you transition to a new job, signing up for all the right benefits and choosing high deductible versus one that covers everything. You might be amazed how it still works out very well for you on the medical side, and there's money being built up for your future years.
Yes, sir. Yes, it's, for my clients, if they're ever switching a new job, one of the first things I want to do before they agree to taking that new job is, let me see the benefit package. Let's see what you're able to use with this new company.
Now, an HSA is yours. It's not your employer's. It's not going to lose it when you leave the company. A health savings account is your account for you to have now and your future. One of the concepts we talked about earlier is that if you have a receipt that you paid regular cash for, or out your regular checking, that receipt you can save for the future and then use that receipt to take a withdrawal tax-free later on if you need money.
Yes.
I like that idea.
It's a great idea. Yeah, it's a great concept that people should utilize.
Now, when it comes to people in their 40s and 50s and they're trying to do everything in life, and this is going to be sort of a trick question, Paul. So let's say you have $1 and you have to decide between health savings, retirement, to put money in either one. How would you make that decision on what is the best thing to do?
I would say that if we are able to make contributions to a Roth IRA, an individual Roth IRA, our contribution limits are higher than they could be on an HSA. So in a Roth IRA, we can use those funds first for basically anything, tax-free when you need them. Uh-huh. The health savings account has to be used for those qualified, health expenses. So, when I'm balancing them out, if we had that dollar and it has to go either to the Roth IRA, the Roth 401k, and then the HSA, my order would be Roth IRA, Roth 401k, then HSA. And I know that might not be the same for everybody.
Right. And I would say if we want to maximize our tax-free, the reason I want to bring our secret sauce today is that the HSA offers putting money in pre-tax.
Right.
Now, if you're going to commit to letting it grow, that's a separate part of the HSA. Then I think that could move up your ladder there to number one. If you're a saver, long-term, have enough money to cover your regular medical expense, all those qualifications, the HSA could slide up your ladder. Now, someone that's beginning and growing and trying to max out, I agree with your ladder. But I think that the idea always comes down to the HSA. Well, pre-tax. I can't get that anywhere else. Mm-hmm. That's a neat idea. That's what we want you to think about today, is doing that.
And the reality is you are going to have healthcare expenses when you retire, throughout life. It happens. So it's not like you're not going to use it.
Now, if you're over 65 and they're Medicare, you cannot have this. So I'm sorry to inform you about that one. All right, so the idea is this. We're add tax-free to your portfolio. Tax-free is what we're shooting for. Tax-free, make sure you understand this, is for qualified withdrawals. What's the word qualified mean, Paul?
Well, qualified would mean it has to be specific to, in the HSA case, it's, something that's for the health reason, deductible, co-insurance, copay, prescription costs, anything like that, insulin, they have to be, you can't be using your HSA to buy a new car, right? So it has to be used for the qualified health expenses. They have to be qualified.
And also qualify means for your Roth IRA or Roth retirement plan is that you're over 59 and a half and that those withdrawals are for retirement. Also means you've had the account more than 5 years to be able to take the tax-free growth out. So you have to have these accounts open for more than 5 years.
Yes. Yeah. And the trick even with a Roth IRA is, and most people don't realize, when you make contributions to a Roth IRA, those are liquid. Your contributions are liquid in a Roth IRA. If you contributed, let's call it $6,500 for this year, you're able If next year you needed it for something, you're actually able to take that $6,500 that you contributed to tax-free and penalty-free.
Yeah.
Not the growth, but just the contributions.
It's a nice way to have some money saved as an extra emergency fund.
Pretty much,
Not as the only emergency fund, but generally as an extra emergency fund if you want to pull that money out. Now, Roth IRAs, there's lots of rules to them, lots of things about contributions and conversions. We've done that on many other shows on our website at acresfinancialgroup.com. But today's show is how to add tax-free to your portfolio, covering these ideas. So what you need to do on right now or even on Monday morning is you give Acres Financial Group a call and you set up a time to go over your options. And then what we need to do is probably go in, log into your work options and see where we can save more to the Roth.
Yes.
That could be your 401k website, your HSA website through the bank, and also through your paycheck, putting more money away, or just sending your HSA a check might be a good idea.
Good, just getting it started.
All right. Thank you very much, Paul, for helping us today's show, Winning in Retirement, on how to add tax-free to your portfolio. Thanks, Paul.
Yes, sir. Thank you. It was a lot of fun.
It was fun. What's great is you guys need to take advantage of the opportunity to add tax-free to your portfolio. We look forward to working with you because we want you to win in your retirement. So take advantage of this opportunity to begin planning with us at Acres Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at acresfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com or call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com. Call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Acres Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Acres Financial Group. Acres Financial Group offers securities through Arcadios Capital, an SIPC and FINRA member firm. Advisory services are provided through Arcadios Wealth. Acres Financial Group and Arcadios do not share any common ownership. Neither Arcadios nor Acres Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.